everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, let's do a quick systems check. If you would, just type OK in the chat box if you're hearing me clearly and seeing my screen all right. Okay, great. Looks like we're up and running fine. If anyone has any issues as we go along, feel free to let me know. As always, keep in mind that there's risk involved with any trades you take. No one trade is guaranteed to profit, so you want to manage risk in a way that makes sense for you. And we'll go over some ideas in that regard with some advanced tools that make risk management quite a bit easier within our WebTrader platform. And also keep in mind that what we go over is not meant to be financial advisement, but is coming from an educational perspective. Now, from our main website, we can log into our WebTrader platform in the upper right corner here. The nice thing about our WebTrader platform is it allows you to trade on MT4 accounts and MT5 accounts from one location, and you can also switch between demo accounts and live accounts. We also have an app that functions the same way, allowing you to trade on both platform types from one location. And so the AvaTrade app you can download from the major app stores. And you'll also notice that it has the signals, the market news, all of the advanced tools and functionalities that we will look at in the WebTrader are also available in our app. Now, we'll go ahead and log into the WebTrader at this point. In the upper right corner is the login, and once you get your email address and password in, it'll look like this. Now, the focus of today's session, obviously, is fundamental analysis, but along with it, we'll take a peek at the technicals as well to zero in on potential entry points and exit points that might be a bit more opportunistic. And so usually hand in hand, the technicals and the fundamentals go together. Now, since we're focusing on fundamentals primarily in this session, I think a good place to start would be the economic calendar to see what's the latest news that has come in terms of economic data, and also what's upcoming through the day today and maybe into tomorrow if we have time to look. So the economic calendar is found here in the discovery section, and what you'll notice is our economic calendar is not your average economic calendar. I think most traders, even if you're pretty new to things, have looked at economic calendars before, and the same basic information is here. Previous numbers from the prior announcements, the forecast numbers, what's expected for the current numbers that are coming in. And then when the current numbers come in, you have the actual column here showing what were the numbers that came in at the time that it was expected, which is listed on the left-hand side here. So these already came in today. I've picked today's date. And also in the filter here, you can pick what countries you prefer to have included. And usually you pick the ones with the more major economies. They tend to move the charts a bit more when the announcements come in. And so looking at just today, the 29th, we can see a bit of data already came in today. In particular, out of the European Union, we see a larger slowdown than expected. If we start to look at inflationary data coming in, it was expected to drop from 0.71 to 0.5, and it actually came in at 0% inflation rate. This is out of Belgium in the Euro area. That's month over month and year over year, coming in lower than expected. Year over year at 2.86% inflation, which is now dropped under 3%, which is well below what the expectation was of 3.7. So you might find that could weaken the euro a bit, be a bit bearish on the strength of the euro, given that shows maybe less demand in the euro area with the inflation rate dropping more than expected. It's not a straight line rule, but typically less demand tends to be bearish on a currency. But we'll take a look at the charts and see what's happening from a technical perspective. But fundamentally, that might be an expectation you could be looking for as the data came in worse than expected in the euro area on inflationary numbers. Now, depending on how you're defining it, being good or being bad, too high of inflation has been a worry. So the fact that it dropped more than expected could even be deemed positive by the equities. So if we're looking at the stock market, you might see a positive response from this sort of data because the inflation has been too high, and the fact that it dropped more than expected could be bullish, maybe for the equities, for the major indices and stocks in a general sense, while at the same time have a weakening effect potentially on the euro. But these are all generalities, and we'd have to look for entry points, exit points to see if indeed that's what's happening. Now, as we scroll down below this red line, we can start to look at announcements that have not occurred yet. Okay, the red line is the present time, and so we're between these announcements that already occurred and the next announcements that did not occur yet. And this is where we can maybe get into using some of the advanced tools that are available on our economic calendar. And so if we go to an announcement that is deemed a bit more significant, maybe this announcement out of Germany, inflation rate, okay, we've got ranked as high level announcement, and we've got year over year data and month over month data on inflationary data coming out of Germany. Now, the expectation is a slight drop in inflation from 2.3 to 2.2 year over year, and from 0.3 to 0.2 month over month. Now, if we take a look using this volatility tool, we can see in the past how has the movement on different currency pairings gone based on how the numbers have come in. And you might project that on the current numbers as they come in, that you might be able to anticipate what direction and how far the movement might go based on whether the data comes in better than expected, worse than expected, or as expected. Now, we can change the currency pairings. I'll stick with Euro USD for now. We can look different time frames after the past announcements to see how has this currency pairing moved. I'll leave it on 4 hours after the events for now. And then we can qualify if it came in as expected, above forecast, or below forecast. So let's say this follows the pattern that already occurred in the euro area, and the inflationary data comes in below forecast, meaning a larger slowdown than expected. And so if that happens, on the month over month data, we see almost 2/3 of the time, the euro weakens against the USD when that happens in the past, okay? And that's kind of what I was alluding to with the earlier data out of Belgium, that when the inflationary data comes in weaker than expected, it tends to be bearish for a currency, tends to cause maybe a weakening pressure on the currency. And that's what we see here has happened in the past with the announcements out of Germany when the inflationary data was below forecast. 2/3 of the time, almost 63% of the time, you see a drop in the 4 hours after those announcements, a drop in the Euro USD. And we're talking pretty significant distances, over 43 pips average range movement. And so there's opportunity there to follow what we call data-driven trading in the direction that you think makes sense based on this information from the past. So you can wait and see how the data comes in, and you can see that if we look 5 minutes after the numbers come in, the average range movement is less than 5 pips in that first 5 minutes. Okay, we see here is 4 pips. 4 pips drop was the largest one. The rest were smaller or even went up. And so it's not like you can't see the data come in and then make your trade. The movement doesn't occur necessarily in the first 30 seconds. You have time to see how did the numbers come in with the inflationary data, and then decide based on the past data, what direction should you trade, okay? In the first 5 minutes, less than 5 pip average range movement. After 4 hours, 63% of the time, we had a downward movement with the smallest really that had any significance over 16 pips, and the larger over 36 pips dropping, okay? So that's another, 10 to 20, 10 to 30 further pips movements over the next 4 hours, 63% of the time in the downward direction, beyond what it moved in the first 5 minutes, okay? With only one of them really hovering where it stayed flat after 4 hours, okay? So very strong information that can help guide your decision on what direction you might trade based on how the data comes in on a particular announcement. Now, what if this comes in above forecast? Okay, After 4 hours, first of all, it only happened once. In the past year's worth of data that is on the screen here being considered. So it only happened once, which it's not very many data points, right? It did drop in the one time that it happened, but not as significantly, only 27 pips, not 40 plus pips. And the fact that it only happened once, I wouldn't put much emphasis on this particular data set. So if it had happened 5 or 6 times and it went up 4 and down 1, then I would say, okay, it shows a bullish trend. But if it only happened once in the data set, and regardless of whether it went up or down, I don't put a lot of weight in the data. So if it comes in above forecast, I might sit it out. If it comes in below forecast, I'd be looking potentially to go with what the data shows happened the majority of the time in the past, if I can get an entry point that I like. Okay? And again, this isn't based on following what I say I would do, but it should be based on what we call data-driven trading, where your trade is based on what has happened in the data set from the past. Okay? It's one style of trading. It's not the only way to trade, but it's one style of trading with fundamental news that allows you to be somewhat robotic, to put emotions aside, and to trade based on what the data shows potentially will bring you more success than loss when you try it 10 times, 15 times, 20 times with a somewhat larger size data set, so that you don't just try it once and if you lose, say, oh, that doesn't work. You want to give yourself multiple tries with limited risk per trade and see after trying it 10 times or so, are you coming out on top more than you're losing for any particular announcement? And you might find that some announcements, maybe inflation rate versus PPI data work better, or maybe the CPI data, consumer pricing index, causes movements that you have more success with this type of data-driven trading. So you can, over the weekend even, go through and pick the announcements who statistically look like they could be strong in terms of statistical influence from the past, and choose in advance which announcements you'll trade on for the upcoming week. And you'll already know in what direction you'll trade based on how the data comes in, and be able to work robotically like that with this type of fundamental news. We can scroll down to later in the day today, and we have GDP growth rate coming out of the US. It's a very strong announcement in terms of the effect it has on the charts. It's a major indicator of economic health, the GDP numbers. And since the US is the largest economy in the world, it certainly is watched by traders and has a significant effect on price movements on the charts. And so we see the expectation is that the GDP growth rate will go up from 1.4% to 2.8%. That would be a 100% increase from the last announcement with this data. So from 1.4 to 2.8% GDP growth rate. Let's take a look at what's happened in the past with this announcement. So if we're looking Euro USD, and again, we can look at different currency pairings. For the sake of the webinar, I don't want to spend the time going through all of the different currency pairings on one announcement, but you could do the favorite pairing that you have, Australian USD, GBP USD, etc. For now, for our purposes, I'll leave it on Euro USD, but you may find different statistical percentages are stronger on different announcements if you check different currency pairings, okay? In general, the Euro USD I found to be pretty stable in terms of percentages with the past data and distance movements. If we start looking at GBP USD, the distance movements tend to be larger in pips range movement after the announcements, but the percentages tend to be closer to 50-50. Okay, so larger volatility with the GBP USD pairing, but less predictability. So I'm leaning towards the larger predictability with maybe smaller movements, but still significant with the Euro USD. But again, each trader has their preference, so you can look at different pairings to see which ones you like best in terms of the past movements for you to try and project the trade on future movements. Okay, so with this announcement, GDP growth rate, if it comes in above expectation, that would be considered good news for the US economy. So above forecast, we see it's only happened once in the past readings that are in this data. And we see when that did happen, the USD strengthened and pulled the euro down over 30 pips. Again, I don't like only having one data point, but that is the direction I would expect, just from a fundamental sentiment perspective. When the GDP comes in better than expected, that's good news. So you'd think the currency for that country might strengthen. And so that's what we see happen the one time that the data shows there was movement. It was USD strengthening with the GDP being above forecast. Okay. Now, if we go below forecast, it happened 3 times. Little stronger data set because there are more data points. And it's what we would expect from what we just discussed. Worse than expected data on GDP means the economy is doing worse than expected. That caused the USD to weaken all 3 times that happened, and in a pretty significant way, over 38 pips, upward movement on all 3 of these, significant movement up, averaging range movement over 38 pips. Okay, so if this data comes in once again below forecast, which might not be hard to see happen because the expectation is such a big increase. So if this misses 2.8% and comes in significantly below that, you may see a repeat of what the data shows happened the last 3 times that this happened. And I apologize, there actually was once that when it came in below forecast, it didn't go up, but it didn't drop much either. Okay, it stayed flat. So it was actually 3 out of 4 times, not 3 out of 3, 3 out of 4. So 75% of the time when this came in, I'm on all events, so I was right. Let's go back to below forecast, and it was 100% of the time. So below forecast, it went up 100% of the time, and you might expect that could happen again, something that you might be interested in trading on. I accidentally had it on matching forecast, none, above forecast once, and I accidentally had it on all events, which then shows that once it went down and 3 times it went up, but the time it went down is when it came in above forecast. The times it went up is when it was below forecast. Okay, so a pretty direct effect there with GDP numbers and the movement of the Euro USD. Okay, as we're going along, if anyone has any questions on what I'm covering, please feel free to type them. I keep an eye on the question chat box there every so often. So we also could look at jobless claims. Does it have an effect as strong as the GDP growth rate? Because this really showed a direct effect. If it came in one way, Euro USD went in a certain direction. If it came in the other way, it went in the opposite direction. So a pretty one-to-one direct relationship with GDP growth rate and Euro USD movement. If we look at the initial jobless claims, not as strong statistical relationship, I don't think, but let's see. If this comes in above forecast, which is bad news, right? Bad economic news if there's initial jobless claims higher than expected, meaning more people are losing work than expected. If this comes in higher than expected, we see the USD strengthen a little bit more often than it weakens. But it's too close to 50% to 50-50 for me to see that as a significant percentage. So we see out of 5 events, as close as you can get to half and half, 2 went up and 3 went down. So I don't see as strong of an effect when this comes in above forecast in terms of statistical significance in one direction or another. Okay, there's a lot of volatility. We've got almost 50 pips of movement, 43 pips movement in those 4 hours, but it's up and down movement, almost half and half. Okay, so then I can look at below forecast. Still almost 50-50, 43% up, 57% down. Volatility, but not predictability with this announcement. Okay, and it could be because this announcement is at the same time as the GDP announcement. And the GDP announcement seems to be the one that's determining directionality rather than the initial jobless claims. So based on these 2 data sets, I would focus on the GDP numbers, and I would go with the directionality based on the past movements if I wanted to do data-driven trading, depending on if this comes in above or below forecast. If it matches forecast, I might sit it out. Usually it doesn't hit the exact number. If it comes in at 2.8%, well, then I'll probably sit it out. But if it's significantly above or below 2.8%, we saw what the past data showed. A high percentage probability of movement in one direction or the other, depending if it's above or below forecast. Now, we can also move on to announcements on other days. I don't think we'll do that today, but you can easily jump to tomorrow's announcements and see a number of high-level announcements out of Japan involving the Japanese yen, Australia with retail sales, some more announcements out of Germany with retail sales, and a number of announcements out of Great Britain. So we've got a lot of opportunities here for you to go through this same process, look at the movement from the past announcements and see if there's predictability based on how the data comes in, and set that up as a trading plan if the announcements are at times that you're able to watch and to act on those trades as the data comes in. There's enough variety of announcements and different time frames that hopefully for most of you, there are a handful of announcements at least each week that you can be available to try this strategy. Okay, and again, I would say give it a month or two of trying this strategy on different announcements and see how it comes out. If you've tried each announcement, I don't know, 10 times or more, and see which ones are working out best for you. Now, what other fundamental news can we look at here? We can go to what we call our market buzz, also found in the discovery section. And in the market buzz, we can search any instrument that's available on AvaTrade and find what is the latest news that's come out about that stock or that commodity or that currency pairing, and make a decision based on that recent news of, do I think the value of this asset will go up or down? And also, most of them will have a trend analysis with the technical analysis outlined for you too, with a prediction of what direction the technicals show it should go. So the bigger circles are in the news more. They have more articles and bits of information found online through this system, and so they have the larger circles. And NVIDIA, no doubt, is in the news a lot. It's no surprise that it's the largest circle here in the pictogram. They just had their announcements that their earnings numbers came in showing better revenue than expected, better earnings per share than expected. But because NVIDIA has been so strong, even beating the expectations wasn't enough for investors. And what I mean is it beat the expectations with earnings and revenue, but what they had to say afterwards was, hey, we don't think we'll have 100% increase next quarter. We think it might only show year over year 70% increase, which is still for any average company a great increase in earnings per share and revenue. But the market has gotten so used to NVIDIA exceeding expectations by so much that if it doesn't beat the last year's numbers by over 100%, it's almost a letdown. And so the fact that they alluded to the fact that rather than beating last year's numbers in this next quarter by triple digits, that it might only, and I say only with quotations, be something like 70% in their current prediction, better than the previous year. That actually caused the stocks to slip yesterday after the better than expected numbers. So if you can understand that situation, NVIDIA's been so hot that even better than expected numbers weren't good enough for a lot of investors. So what we see though is the longer term prediction here for the technicals is that the price should still continue to rise even up to 30%, 29.6% in the coming weeks. So this is the technical breakdown of what is expected, barring, anything can happen in the news, right? If the war situation in the Middle East gets worse, barring major events like that, the expected movement is NVIDIA to keep climbing nearly 30% towards these price levels, okay? This is based on the signal coming from Trading Central. And you can read all about the indicators that were used, RSI, MACD, moving averages. You can see the important price levels, breakdown of all the technicals, support and resistance levels. So that's one thing, is to understand that the technical expectation is for this to rise. And fundamentally, they did beat the expected numbers in these announcements that came yesterday. So that's the good news on NVIDIA. Now, the other side of it is the forecast now is for not triple digits beating last year's numbers, but double digits beating last year's numbers, maybe for the next quarter. So that pullback probably temporary, could pull back further, but here you see an article explaining the shares fall after earnings beat estimates, but we understand, as I explained, what that's about. It isn't because there was bad news, it's because it was really good news, but then they talked about the results moving forward might be good news rather than really good news, right? Still a strong stock based on the expectations, though. So here we can start to read the articles and understand. If you click on the links, there's a synopsis, a small summary of the article, or you can click and read the entire article. It takes you right to the source, in this case, CNBC, and you can read the article for yourself to see what it is they're talking about. What's going on with NVIDIA and the numbers they just reported, and the pullback that occurred yesterday. So this is a source where you can easily find information, the most current information at that we can pull off the internet from a fundamental news perspective to then drive your decision making as to whether you trust maybe technical signals that are coming out predicting a movement in a certain direction. Okay. And if you look at the chart and see a pullback on NVIDIA, now you can understand why it pulled back based on the article here about their earnings beating estimates, but the future forecast being maybe not as strong as the past ones. Okay. Any questions, comments? I'll pause for a moment. Okay, so what we could do is take a look at some charts as well. And it can be really anything. Doesn't have to be related to an article we looked at or one of those announcements, but we did see some weak data out of the Euro area. The US data has not come out yet today. There are some announcements that we looked at, GDP numbers, for example, but that's not until a little while from now. So as I expected, we can see the Euro dropped here against the USD. What's with this dropping on the 2-hour candles over the last, say, 4 hours? We see a large drop in the Euro against the USD. Could be directly related to that lower than expected inflationary data out of the European Union, showing a larger slowdown than expected, which could be a welcomed slowdown as inflation drops faster than expected, but also could have a bearish effect on the Euro when it shows a larger than expected slowdown in the Euro area. So we see that pullback here. Okay, so certainly a downtrend. We can take a look at the most recent signal to see what's the expectation here with the Euro, and it's to go up. Okay, so the fact that there's a technical signal to buy and a fundamental reason that it pulled back, okay, you have competing interests there, right? So you could start to qualify which signals you want to follow and which ones you don't. If the fundamental news aligned with the signal, if the data came in better than expected out of the European Union, and there are more announcements coming, by the way, some announcements out of Germany. So if that data comes in better than expected now, then maybe you go with this signal with take profits towards the take profit suggestions, but you can qualify whether you'll follow this signal to buy, and you understand why it pulled down, perhaps the data out of Belgium being weaker than expected, but now await the data out of Germany, and if it comes in better than expected, not only does the data from the economic calendar show that, hey, the Euro tends to climb then, but also we have a signal here saying that the Euro should climb. So you can wait for that announcement later today and decide whether you'd want to buy on this or not. Okay, and you'd have two reasons then to do it. The technical signal showing to buy with take profits up as high as 111.40, and also if the announcement came in a way better than expected that makes you think the Euro should climb. Okay, so you can start to pre-plan which exact instruments you would trade on, waiting for the announcement. Or if the announcement's already occurred, let's say that the announcement out of Germany already came and it was better than expected, now I can start to look at the chart and see, okay, this hasn't reached the take profit yet, it's a buy signal, I'll go with it then. if that data that came in supported that. Okay, so this is what I mean by combining the fundamentals with the technicals to then have an educated plan to trade on perhaps the signals that we offer, but only on the ones that the fundamental news that you know of that currently occurred, if the fundamental news supports that signal. Because sometimes these signals come out before the news, and the news can change the momentum and really make the signal not as desirable. Okay, a lot of times the signals are based on technicals prior to announcements coming. So you have to keep that in mind when you look at the signals and do a little legwork yourself to qualify which signals do you want to go with and which do you not. Okay, taking into account recent or upcoming fundamental news. And I don't see any questions popping up, but we can look at another instrument. I think a nice one is gold, because we have those GDP numbers coming out of the US. If the data of the US GDP information that's coming soon later today comes in a way that shows the USD should weaken, and we saw that's what the GDP numbers did. If they came in below expectation, the USD weakened. If they came in above expectation, the USD strengthened. Perhaps gold then is an easier buy if that data came in below expectation and you expect the USD to weaken. Then perhaps if you can find the right entry point, you might decide to buy on gold. And the opposite, if the GDP numbers come in higher than expected and the past data shows the USD typically strengthens, you might find an entry point you like to sell on gold based on that. But you have to obviously put those data sets together and find an entry point that you like as well. So looking at gold just from a technical perspective, we can look at the technical signal on gold. And the signal says buy. Okay, why would that be? Maybe there's an expectation that the US GDP numbers could come in weaker than expected. Maybe there's fear out there about a weakening economy. We see the Eurozone already showed numbers worse than expected. If the US data continues to show worse numbers than expected, the USD could continue to weaken with anticipation of rate cuts then. The weaker the data out of the US, the more likely the US might cut interest rates finally, after all the increases that they had to stave off inflation. So maybe there's an anticipation that more data out of the US might lean towards more likeliness of rate cuts. And so we see gold starting to climb right now, maybe because of that type of reasoning. So if we look at the larger picture on gold, 1 week candles, we see it's been hitting all-time high after all-time high. Clearly, there's economic fear out there, perhaps fear that inflation could come back if rates are decreased in the US and other places, because inflation has not gotten down to the target of below 2% in the US. And if they're already talking about cutting interest rates, that could just cause inflation to come roaring back. So whatever the reason be, whether it's economic slowdown fears or returning of inflation fears, we see gold hitting all-time high after all-time high here, and it seems like it's poised to try and climb again based on this signal of 2540 as the higher take profit suggestion in this signal. Okay, so is gold uptrending now? It is. On the large candles, on the small candles, it's uptrending. So if you like this move, from a technical perspective and a fundamental perspective, you might have reasons to make a buy move on gold, perhaps. Now, obviously, if you think the opposite, maybe you want to wait for the GDP data. If it comes in higher than expected, maybe you do the opposite move. But preemptively, if you wanted to make a trade, it is uptrending currently. And if you wanted to protect things through the announcements, you could use something like AvaProtect. I could protect by the hour or by the day. Today being Thursday, if I do 2 days protection, I'm protected all the way to Monday. Okay. September 2nd, this is my expiry next Monday if I do 2 days protection on gold. And maybe I think by then gold could have a reason to make a big move up or a big move down. And you can protect either a buy or a sell longer term with this sort of setup for a limited cost. Okay, it depends on your trade size. If I do one lot, the protection costs less than if I do a larger trade. Okay, and the protection cost is outlined there for you. So you have some options in terms of risk management, as well as directionality, depending on which instrument you're looking at and which fundamental news you're queuing off of. All right, everybody, thank you for joining. I think this is a good place to stop. I didn't see any questions pop up, so I must have been pretty clear. Thank you all for joining, and until next time, good luck with your trading.